So you tested your strategy for 100 times and you went to the market and you start trading. But then everything went wrong. Nothing went according to your plan. And you wonder why. Didn't you practice enough? No, you did. I'm sure you did. Or maybe it was because you didn't learn your strategy correctly. No, I'm sure you did. Yeah, you're a smart person. Or maybe because you weren't patient enough for the right setup. Could be. It happened to all of us. Yeah, it's hard to be in front of chart and waiting. Or maybe you didn't test it enough. Yeah, you tested for 100 times, but maybe you had to test it for 1,000 times, maybe 10,000 times, maybe 1 million times, maybe 1 billion times. No, you have to test it for 1,000,000,000,000,000 times. But why? Well, simply because of power of statistics and big data analysis. With one single individual random event, you can't even say what's the possible outcome. Even with hundreds of them, it's still unpredictable. But when you look at millions of them, they become completely predictable, completely ordered. Casinos are using statistics over their probabilities all the time to make sure they have the edge over the players. For instance, in blackjack, the win rate of the house versus players in a portion of like 1,000 games is around 50-50. But when you look at the billions games played, the percentage is in favor of the house. And that's how they make money. The pattern is actually there, but it appears when you look at the large scale. So either you know how to code your strategy, or you are learning how to code, or you ask someone to code your strategy, or you whether thinking, should I buy this trading bot, or anyone wondering how should we evaluate a backtest of the trading system. Make sure your backtest results have these metrics, because if you really want to evaluate the performance and risk of your trading strategy, these are the one professionals looking for. The Sharpe Ratio tells you how much risk you took to achieve your profit. I saw a lot of traders, and even they have this phrase, trade needs to breathe. Yeah, so you enter a trade, you go until 80-90% loss. If you're trading with leverage isolated mode, you're already done, liquidated, rest in peace. But if you are in a cross mode, you might go down by even minus 200% sometimes, and then come back and you take 10% profit. Yeah. Many traders or trade systems don't use stop loss. Why? Because they don't want to get bad reputation and bad records. And therefore you see they have a good win rate, but the reality is they are willing to take too much risk to get that tiny profit. Most of the traders you see in the trading platforms that offer copy trading use this trick. Well, they need to have a good record of their historical trades, so they don't use stop loss because it will ruin their record. So that's what they do to get past and be eligible to get other traders to copy them. They might have good ROI for the past 30 days, but personally, if I'm not able to see their Sharpe ratio, I'm not willing to invest a single dime into them or their system. Yeah, you might have had perfect 90 days with that approach, but it's going to be one day that you face that minus 200% loss. And that's a disaster. It's my second, sometimes first favorite. It's the same as Sharpe Ratio, but it focuses only on the downside volatility of returns of your portfolio. So it focuses more on the downside of your system. It's really important how you proceed to calculate these two ratios. If you are an investor in a stock and you put your money there for a year, then the way you want to calculate it, it's going to be different from when you want to trade daily. Profit factor is very simple, but it's an effective measure. It's one of those you always want to have. So you take your total gain, I mean how much money you made, and you divide it by how much money you lost. And if that number is greater than 1, you are good to go. It's less than 1, stop trading, redesign your strategy. You want this number above 1.5, above 2, excellent. So if this number is around 1, it shows your system is making money, but also losing all of it, as if you never did anything with your money. And if it's below 1, it shows that you are losing money. It's in the same category as profit factor, but it works with the quantity of the trades. So the number of winning trades divided by number of losing trades. It's not so important metric actually, but it's a nice complementary to profit factor, which is the most typical metric everyone uses and typically everyone cares about. It's just the number of winning trades versus the whole number of trades. From each 10 trades, you might have 9 winning trades, but one trade, just one trade, can blow up your whole portfolio. So really pay attention. Win rate, win-loss ratio that works with the quantity of the trades doesn't give you anything. But profit factor is talking to you about whether your trading system is profitable or not. Even if you don't utilize Sharpe Ratio and Sortino Ratio, please utilize profit factor because it's really easy to calculate. Everyone can do that, and it's much more important than win rate. We want to see if we invest like $10,000 in this trading strategy, how much we went down historically. It's something that is very tangible and you can really see the downside of your system. It happened in my own testing. Sometimes I see a portfolio with an initial 10K capital went down until $1,000, but then went up until 18K. But who really wants to take that much risk? This meter for me actually it's in the same category of Sharpe Ratio and Sortino Ratio because they're speaking of risk. In such a system I just exampled, I already should know by these two metrics that my system is very risky. But here I can see how much exactly we went down in the period of trading, which helped me to know for how long we were in the anxiety period and how long we were waiting on the top, waiting for more profit. But then we got a little bit disappointed because it's the maximum. So it's obviously we end up less than that amount. In a way, they have also this quality of psychology, which I really admire. So this is useful if you're trading stocks or crypto or oil. So in the period of the backtest, you want to see if you just simply bought that asset and hold it. How was it comparing to your trading strategy performance? Sometimes you had very good results, but then you realize you had much more profit if you just bought it and held it. So you can maybe see whether if you increase the leverage would solve this problem, or actually the problem is somewhere else. So this one is a bit complicated to utilize, but I love it. And it's your system positioning versus random positioning. So what does that mean? In this test, we have the same portfolio management and risk management strategy. Everything is the same except how we enter the market. We have the same portfolio management and risk management strategy. Everything is the same except how we enter the market. How we position ourselves into the market is going to be tested versus randomly entering the market while having the same position and risk management. First of all, we want to see this comparison to make sure our strategy is robust and it's not just random or worse than random. And secondly, this test shows the strength of our position management and our risk management. Sometimes we see there is not so much difference between our system and the random positioning. And that shows that all the good results we saw before, it was just because of our risk management. So our risk management was so good that even didn't matter if we just entered the market randomly. Transaction cost. It's very crucial to have in your backtest. It's a game changer, but not in your favor, unfortunately. If you're not involving transaction cost into your backtests, you're just playing with numbers. Most of the brokers, they don't let you go down more than minus 90% in loss, so you always get liquidated way before your margin if you are not using any static stop loss method. So you have to know what's the liquidation rates of the broker and include it in your backtest. And the last thing I would do, I fetch again all these metrics and I separate them based on long and short. So I want to see all these metrics separated by long and short, because to see whether maybe for this market we want to have in our portfolio, only long trades are beneficial. And it's also maybe we have a fundamental reason that support this idea to only trade longs in this particular stock.